This is Ivan Scherman. He achieved a monstrous 491% return that made him the 2023 World Cup trading champion, absolutely crushing the competition with over 200% more performance than the second place trader. Ivan's 491% return was 20 times more profitable than the S&P 500 in the same period. But here's what's incredible. The strategy Ivan used to win is so simple that even a complete beginner could apply it. Today, I'm revealing his exact championship strategy. First, I'll break down the core principles behind it, and then we'll jump into live charts where I'll show you exactly how to apply it step by step on TradingView. And stick around until the end because I've discovered something that solves the only vulnerability in Ivan Scherman's strategy. Let's get straight to it. Ivan understood a fundamental truth about markets. The S&P 500 is naturally bullish. Over the past decades, it has generated an average 10% annual performance, moving in a clear upward direction. But within this bullish trend, pullbacks form, small temporary retracements that create golden opportunities to enter the trend. Scherman's strategy does exactly this. It identifies the general trend as bullish, waits for pullbacks within the trend, enters when the pullback exhausts itself, and rides the trend continuation. Scherman's championship strategy is based on 3 super simple rules that anyone can follow. The first rule is that the S&P 500 must be in an uptrend. How do we determine if we're in an uptrend, downtrend, or range? Ivan keeps it simple by using the 200-period simple moving average. So first, go to TradingView, click on Indicators, search SMA, set period to 200, and make it blue or the color you prefer, and I suggest to increase thickness. This moving average is your trend filter. Every time the S&P 500 is trading above this line, it means we're in an uptrend. Every time it's trading below this line, we're in a downtrend. Ivan only looks for buy opportunities during uptrends, so whenever the S&P 500 changes from uptrend to downtrend, or is already in a downtrend, there's no strategy, we simply don't trade. The second rule is wait for the perfect pullback. Within that uptrend, Ivan waits for the S&P 500 to fall for 3 consecutive days. The moment it drops for 3 straight days, forming what is called a pullback pattern, he buys at the opening of the 4th day. Let me show you exactly what this looks like on the chart. Here you can see the S&P 500 is in a clear uptrend. It's rising and trading above the 200-period moving average. Even though we see some bearish candles forming, they're not 3 consecutive days. Here we have 3 consecutive days, but if the candle is red but didn't close below the minimum of the previous candle, the setup is not valid. As you can see here, it is a bear candle but closed clearly above the previous one. Look here, we have our first bearish candle, a second one, and a third consecutive bearish candle. Now we have the structure we're looking for. The S&P 500 in an uptrend above the 200-period daily moving average and having formed 3 consecutive bearish candles. So what Ivan would do right now is wait for the opening of the next candle to execute a market buy order. That would place our entry right around this level here. The third and final rule determines when to close the position. We exit precisely when price continues higher with that uptrend and closes above the 5-period simple moving average. Click on the Indicators tab and add the simple moving average. Set it to a 5-period SMA with white color. I personally prefer to increase the line thickness a bit. The moment the price closes above this moving average, like this candle right here, we wait for the opening of the next day to close our position. Simple and effective. Let me show you a new example to review each and every rule in order so everything becomes crystal clear. So let's go directly to the chart. We're obviously still on the daily S&P 500 chart. The trend is clearly bullish. I'm not saying this, the moving average is telling us this as it's positioned decisively below the current price level. Let's review what's happening in this structure we're seeing now. We're seeing a small deceleration. We've had 1 and 2 bearish candles, but haven't reached the third, so we haven't completed the pullback. Price continues rising, starts to decelerate, and then forms several bearish candles. Would this sequence work? The answer is no. Why? Because we have a first bearish candle, and even though this candle here is red, and this candle here is also red and bearish, if we focus on what happens with this intermediate candle, we'll realize that the close of the first candle is here, and the close of the second candle is here. So while it's true that there are 3 red candles, even 4 with the last one, What we have is a gap that forms an upward movement, and the close of the second candle is above the close of the first candle. So we skip the trade. Price continues with the upward movement, one bearish candle, two bearish candles. Now we should see a new bearish candle, and here we have what appears to be correct, a third bearish candle. Now what do we need to do? We would wait for the opening of the next day to execute a market position. Here we have the next day. I'm going to put a point in this area here and mark it in blue to indicate our entry point. Now we put our target above the 5-period simple moving average. This simple moving average here, the white one, is precisely what marks our exit point. So let's see what happens here. We automatically have the close above it, and what we would need to do is wait for the next candle to close at market price. This candle opens here, so I'm going to place the exit point here. The take profit is at this point, and we would have captured this entire bullish move. Now, there's a big problem with Ivan's strategy. He never specified where to put the stop loss, and this is serious because you can't trade without protection. According to Ivan's own backtesting, this is a strategy with an 80% win rate, but that backtesting was certainly created by a stop loss zone and possibly also includes position management techniques. So I did something that took me a lot of work. I backtested this strategy with dozens of different stop-loss approaches across nearly 30 years of data from 1997 to 2025. Fixed percentage methods, volatility-based approaches, moving average techniques, you name it, I tested it. And I discovered something really interesting. When I combined the ATR-based stops with a fixed percentage cap, the results were absolutely mind-blowing. The fixed 3% stop loss delivered a 76.47% win rate with a profit factor of 2.45 and only 8.23% maximum drawdown. And here's what really caught my attention. The 2x ATR approach gave us the best risk management with only 7.3% maximum drawdown, while maintaining a solid 74.29% win rate and a 1.95 profit factor. What if we combine them? Use the 2x ATR as our primary stop-loss method, but cap it at 3% maximum to prevent excessive losses during extreme volatility periods. But wait, there's something incredible I discovered while analyzing the backtest results. Scherman's strategy showed impressive consistency across nearly 30 years of data. Until 2018, we're talking about dream results, an 85% win rate with winning streaks of 10 consecutive trades. But then something changed. Flash crash moments, COVID, Trump's tariff announcements this year hit this strategy hard. And that's not all. I noticed that October and April months were particularly problematic. And this is where my ace in the hole comes in, a tool called forecaster.biz. Look here. The first function I use is seasonality analysis. Look at this monthly breakdown. See April and October? April shows a 100% short tendency, meaning it's historically been a bearish month. And October? Look at that, it's showing significant bearish bias as well. This perfectly explains why Ivan's strategy struggled during these specific months. The market itself has a natural seasonal weakness during these periods. And look at these daily patterns within November. You can see how certain days of the month tend to be more bullish or bearish. This level of granular data is pure gold for timing our entries. But the real secret weapon is this second function, COT report analysis. The blue line represents the S&P 500 price movement, and these red bars show the asset managers and institutional positions. Look at this pattern right here. See how the institutions were reducing their exposure while price was still climbing? And look here, the institutions were already pulling back their positions while retail traders were still bullish. This divergence was a massive warning sign that most traders completely missed. This isn't just data, it's like having a crystal ball into institutional thinking. Now, I'm not saying to use this as the only indicator to predict a financial crisis. That would be too simplistic. But combining Ivan's strategy with these insights from Forecaster gives us an incredible edge. When we see Ivan's strategy signaling a valid setup, but we're in a statistically problematic month like October or April, and COT reports show asset managers reducing positions, that's when we can be more selective and maybe skip that specific trade or reduce our position size. If you want to try them out, I'll leave a link in my description for a special offer. I'm sure you'll love it. That's all for this video. See you guys next time.
you.